Good morning, ladies and gentlemen. I'm Rhamy Alejeal, CEO of People Processes, and today we're going to be talking about annual compensation for 2025. It's getting to the end of the year. We're getting a lot of questions about budgets, what people are looking at for 2026 for their compensation planning. And I've got a couple of numbers for you. We're going to break this into two broad categories: cost of living adjustments and merit raises. We have data on both of those I'm going to be sharing with you today. Keep in mind, in your organization, you may or may not be looking at breaking these in two in terms of talking to employees. Okay, it's totally up to you how this is structured. In general, the best data is market rate adjustments. That's where you look at each individual job, see what other people are paying for similar experience, entry level, executives, etc. Look at what you're paying and identify the gap. See if you're paying in the top 50%, the top 25%, the top 10%, or the bottom 10%. And that's the best way to manage your compensation budget. I personally like to do that at least annually and do it again per job, but that's quite complex. Many organizations are asking at this time, all right, look, we're doing our 2026 budget. I understand we're going to have some adjustments higher than this, some lower depending on the job, and I want broad data. So I want to give that to you. First, let's talk about inflation. Inflation is a good kind of metric for cost of living. It does not apply all over the country, right? I'm going to go do regions here, but if you're in a high cost of living city, look that city up. It could vary significantly, okay? In fact, some of the cost of living large cities have had some weird effects this year where, in fact, their inflation is negative, right? Because so many people have fled the city, or you've had significant tax increases to the extent that actually it's lowered the cost of living to some degree, real estate recessions, et cetera. But here are the regional information. For the United States, in the west of the country, 3.2%, Northeast, 3.3%, Midwest, 2.8%, and the South, 2.6%. So if you're in the South like me, your COLA adjustment, again, back of the napkin, 2.6%. That's about what it takes to pay this year, or coming into 2026, to get them the same pay as last year, okay? Doesn't mean you're going to just apply that across the board, but you can and use that as kind of your baseline. Now, for merit increases, so that's been here a year, you have more experience. What is the value of an additional year of experience, who's pretty good? We have some pretty good data. Mercer has an annual compensation survey that just came out, and it's returning a little bit of sanity to the world of compensation. The post-pandemic frenzy of double-digit salary increases and frantic market adjustments is pretty much behind us, according to that. The economic environment remains, very foggy, lots of changes. There's lots of uncertainty around tariffs and labor market and AI, and so some areas are softening and some are remarkably resilient. But we're seeing compensation budgets that look more familiar, getting closer to the historical norm. So in 2026, employers are projecting a merit increase budget of 3.1% across the entire system, 3.5% total increase in budget. So now, again, this is the merit section, and this means that normally these are combined with the COLA adjustments. Now, some companies, the data is not super clear, right? Merit should be separate from COLA, but I personally think when I look at this data that they've incorporated some level of inflation adjustment in there. This is the third consecutive year of relatively stable merit increases from the post-pandemic spike in 21, 22, and 23. Those years were crazy. A lot of them were double-digit pieces in there. So this is a pretty big change. The spend-at-all-costs approach to attract and retain talent is no longer sustainable, as we all know. Instead, that focus needs to be on smart, targeted investments that address specific business needs and mitigate risk of continuity issues if you were to lose particular people. A one-size-fits-all approach to compensation is not just ineffective, it's a recipe for screwing up, right? You're gonna fail to close critical pay gaps, and you're gonna wind up having high turnover in certain parts of your jobs, in certain job titles, and some in others. So again, a market salary adjustment's the best. Still, I want you to keep that number in mind, 3.1% on your merit increase. Now, there's two labor markets here. This is a big deal. We are no longer in a situation where all jobs are in high demand. Instead, we're seeing a really clear separation between sectors that are heating up and those that are cooling down. On one hand, the market for frontline, hands-on roles is moving faster than ever. Sectors like manufacturing, transportation, engineering, construction, they are still experiencing significant wage pressure. For those, you may want to think closer to 5% or even 6% for merit. The demand for skilled labor in those areas far outstrips supply, and companies are finding that they need to be very aggressive with their compensation to attract and retain the talent they need to grow. On the other hand, the picture for white-collar jobs, particularly in tech functions and HR and accounting, is more complex. The rapid advancements in artificial intelligence are having a real impact, and we're starting to see it. We're starting to see them automating some of those tasks and creating new roles that require really specialized skills. So top AI talent can command a significant premium, as I'm sure you all have read, but we're seeing a softening in the broader tech job market, especially entry-level and non-specialized roles. The trend is likely to continue, and so for those sorts of jobs, you may want to be looking at closer to 2% or even 1.5% as that merit increase. Or unless, again, they are on that cutting edge of AI tech and they're able to do a whole lot, right? Then you want to kind of look at that as a separate competency. Another layer of complexity is the evolving landscape of remote work, according to this Mercer survey. While remote and hybrid work models are here to stay, we're seeing a trend of smaller pay increases for fully remote workers, okay? Over the last year, not 2026 projections, but 2025, we saw a 3.6% year-over-year total compensation increase for fully remote compared to 4% for all employees, which means it's probably closer to 4.5% for purely in person. This development calls for careful consideration. So you got to look at this and make sure if you're looking in one part of your organization that your compensation doesn't get too out of whack here. Yes, remote work is likely more competitive for the job seeker, so you can pay a little bit less. But keep in mind that women are more likely to participate in remote work. So evaluate closely your pay increases, your process, just to make sure that decisions are based on performance and contribution, and that the outcomes are not ripe with unintentional bias, okay? You do not want to wind up in a situation where, because of the organization's structure and much more remote work among women, you wind up underpaying significantly women, okay? I just want to give you that. Put it in the back of your head. You don't have to do an in-depth diversity analysis, etc. But if you look and you're giving the in-person guys 6 and 7%, and all of the remote people who happen to be women 2.5 or 3%, just take a minute and make sure you really know what you're doing and are documenting. Okay, it's probably not a good idea. So in this complex environment, I want you to spend wisely. The days of just spreading your budget all over and everybody gets a 3% this and a 4% this is just silly. It's a waste of money. A uniform across the board increase does little to address the nuances of the current labor market. The best, again, as I said, is market value analysis. Look at each job, rate it on what pay percentage that you're kind of in, the percentile of pay compared to the survey data, and look to see if you can move your underperformers to that middle area and your high performers, maybe give them a little less of a raise, okay? But if you need some generalized budgets, let's recap. West, 3.2, Northeast, 3.3, Midwest, 2.8, South, 2.6. And then a merit increase of 3.1% on top of that. Add it together, your budget, 6%, okay? 6 to 6.5. If you're in a low cost of area like the South, maybe that could be closer to like 5.5. This is total compensation, not just pay. So this should also incorporate your benefits costs, your 401k match, your PTO, etc. So don't be silly and just kind of look at your dollars and say we're going to give them a 5% raise. Though you can if nothing else changes, but that's a good way to do it. And then, of course, now we've talked about the company structure. This is your total budget. Then we looked at adjusting it by job, right? And then in the end, it comes down to the individual, right? So attaching this to a performance review process so that you can get an idea of rewarding your top performers. That's going to be a really important part of this too. I know it's complex. This video is not going to go deep into designing a full compensation plan. We have other videos on that, though, at the channel if you want to check it out. We also have a great video on variable compensation and how that works in terms of bonuses, performance incentives, commissions, etc. Check those videos out as well. Thanks for tuning in. My name is Rhamy Alejeal. I hope this helped you out. Now it's time for you to go out there, have a great day, and get your work done. If you need help, book time with me. Any US-based business owner and executive with more than 10 employees can book 30 minutes on my calendar. Be happy to talk you through this, work on any of your comp issues or questions, see if we can work together in the long run, and I'd love to help. Have a great day. See you soon.